Welcome to EVNTAlpha, where I cover economic news and data, the S&P 500, and stock trading signals with captivating historical returns. Amidst continuing escalations in the conflict between the U.S. and Iran, a major hawkish shift in rate hike sentiment, and cracks starting to show in S&P's price action, many investors are left on edge as to how far the S&P will drop after the very serious escalations in Iran. Let's look at the charts and data to decide that for ourselves. The Iran conflict continues to escalate further, in which very early yesterday morning Donald Trump posted an alarming Truth Social post in which he said, "From this point forward, anytime the Islamic Republic of Iran shoots at a ship in the Strait of Hormuz, whether it be by missile, rocket, drone, or any other device or weapon, the United States will bomb and destroy one bridge or power plant, including those located next to or in the capital city of Tehran." Iran promptly responded to these threats, saying, if the Americans target a bridge or a power plant in Iran, Iran will in turn strike infrastructure and bridges in the region, including energy facilities where the United States has interest. Yesterday marked the 12th straight night of strikes we saw from the U.S., really showing how far this has re-escalated. We are now seeing the 13th day of escalations with no signs of it slowing down. As it's been reported, Trump is planning a massive attack on Iran, saying the Iranians haven't received enough pain yet. Realistically, this is going to amass to a continuously larger problem, as oil topped $100 a barrel after it was reported that Houthi rebels targeted Saudi ships in the Red Sea, threatening to cut off a crucial entry and exit point for oil exports. Now we saw a massive shift in rate hike sentiment over the past 3 days, as more and more bad news came out about this geopolitical conflict. As you can see, interest rate hike probability spiked up to 33% over the past 2 days, just after we had thought a rate hike was becoming out of the question. There is no question that oil is going to impact inflation, with us being back at square one with oil prices. In addition, the supply shock is going to continue to worsen as the Strait of Hormuz remains unstable, leading many to start preparing for a major move down, which we will talk about in just a moment. Our next interest rate decision is on July 29th next week. If we get a hike, the markets will very likely be a bloodbath, so be sure to pay attention next Wednesday afternoon, as this could very well be the decider on the direction we see the S&P go over the next few weeks. If we do maintain a hold, keep an eye out for Warsh's language in the meeting after to see how spooked the committee is regarding oil price and inflation concerns after news of these developments in Iran we talked about. The reality is, while the probability is still lower than the hold, this is certainly pressuring the Fed to consider getting ahead of inflation risks and eliminating any chance of a cut this year. With the environment we are currently in, it's time to prepare for the markets to potentially go down further. The ABCD pattern to the upside we've been talking about has been nullified after a strong rejection at 75.78 and the breakdown through our yellow zone. In addition, our triangle break has been nullified as well, as our second retest has occurred on the triangle, marking a lower low than the low on the initial retest, as well as a shift into a downtrend showing a lack of bullish conviction. Given the sudden shift in environment, it's no surprise we are lacking in that department at the moment. However, notice we do still have our trend line from the bottom of our triangle that is not broken. In addition, with our realized pivot at the first target of the triangle breakout, we have now formed a larger triangle pattern. It's possible we see bounces off this trend line. However, given what's going on at the moment, I think it's safe to say it's more likely to see us start trading below the trend line versus hold to support. If we do see the break to the downside, it implies we go on to test the pivot lows created along the way. Notice the first pivot low is very close, in line with our 78.6 retracement of our up move from June 9th to the peak we saw on July 15th. For the past week or so, we've been highlighting that if we start trading below our yellow zone, which is the 78.6 and 61.8 retracements of our move from the peak at the start of our June to our trough, it's very likely we go back to retest the 7300s in the green zone like we saw on June 15th. If we continue trading lower, keep an eye out on that level, as we are likely to see some consolidation or choppiness. It's still possible we see a bounce from that green zone if news sentiment starts to shift back to positive. However, again, until we see signs of that, the focus is our target in the green zone, as well as the potential downside break of our trend line. A break below this green zone means we're probably retesting the lows from June and potentially seeing our lowest lows since the start of June. Given there aren't many catalysts at the moment that present a good environment for a bull run, as well as the break in structure to indicate a shift to the downtrend, our focus is now the potential downside break of our trend line, as well as the green zone as our downside target. Inflation risk has been heightened, leading to a hawkish shift in the Fed, so our Fed decision will likely be neutral or bearish. Trump is not showing signs of wanting to revert to peaceful talks, similarly to Iran, so any headlines around seeing things get better is unlikely to spark buyers in the immediate future. And we likely see some after effects from this oil shock in the coming months as the world runs on oil. Higher prices for longer means higher prices trickling into everything associated with it. I hate to say it, but it looks fairly meek for the bulls at the moment. So let's talk a little bit about SOX. It is the largest index for semiconductors, and the head and shoulders pattern we talked about last video has been nullified for the time being, as we had a pretty strong break back above our neckline. The strong pivot we saw the last 4 days and the relative strength we saw in the index today is fairly bullish, so keep an eye out, as if we continue to hold this support zone, it's very possible we see retests up to our pivot highs at 13,400 and 14,600. Notice our neckline is in a good position to help mitigate risk. If we break back below the support zone that was resistance on Monday, then it puts our downside targets we talked about back in scope. For the time being, seeing this bounce is a good sign that semis were not a large contributor to the exit of value we saw in the S&P today, as pretty much all of its constituents are in the S&P. Whenever you see strong relative strength like this, meaning it's outperforming its benchmark, this indicates it will likely be a strong leader amongst other industries when we do see a shift to a bullish environment as a whole, or may also continue to go against the grain if we continue to see the markets as a whole go down. First stock I want to talk about is ticker EME or MCOR, in which an RSI buy signal with a MACD confirmation occurred today. To elaborate on this, in the first panel we have EME's price over the past 3 years. In the second panel we have RSI, and in the third panel we have MACD. Now with RSI, your typical buy signals is when it crosses above 30 after being below, and with MACD, your typical buy signals are when the white line called MACD crosses above the red line called signal. The strategy in which I use to combine them is identifying an optimal threshold for its RSI average to be below, while RSI crosses above its average, along with MACD experiencing the bullish cross between its white and red lines shortly after. Now EME rose 55% on average over the next 113 trading days, or about 5 months and 3 weeks, across 8 triggers over the past 3 years, in which on all of those occasions the price was higher than the trigger price by that 113th trading day. Now, in addition to the staggering average return it was able to achieve across those 8 signals, it also outperformed the industrial sector by 38% on average and the S&P by 40.5% on average over that same time frame. A 9th signal has occurred today, so keep an eye out for EME, as based on historical reactions, it certainly has some potential to rise. Taking a look at its reactions on the x-axis, we have trading days out from the signal, and on the y-axis, we have cumulative percent change. So in other words, what you're viewing here is what your individual returns would be if you were to buy MCOR on each one of the trigger dates and hold for 6 months. The blue line is the average performance across the 8 historical triggers, in which you can see it lead up to that average 55.5% on the 113th day. Biggest thing I want to note here is notice the momentum in the average really start to pick up after the first 40 trading days or 2 months, in which that is when you really start to see prices pick up. In addition, within the first 2 months, there's a lot of choppiness and flat performances, hinting that it's very possible we see more enticing prices than the close of day over the next 2 months before it goes on to perform well. Taking a look at the min return of these reactions gives you a good idea of how far EME drew down from the trigger price before it did go on to outperform, and how long it took to recover, in which in the worst case scenario of what we've seen in history, the price finally reversed leading into the 4th month and went on to recover to be up 13% from the trigger price over those following 3 months leading into the 6th month. So bear in mind, if you were to see something like this again, you know that it is not out of the ordinary. So don't panic, as you potentially have an opportunity to add more, as it wasn't long before EME was able to recover historically. should you be stuck in a drawdown, for example. The last thing I want to emphasize before we jump into the next portion is these historical triggers are optimized and do not guarantee future performance will be the same. There's always a risk in picking individual stocks. So while history has shown that the price is more likely to go up from here over the next 6 months, it's important to acknowledge and remember things can go wrong, and you need proper risk parameters to protect yourself from a downside risk you are uncomfortable with. On the other hand, when you pick individual stocks, one of the benefits that can occur is while, say, the S&P is down, the stock you chose within the S&P may still be up. Taking a closer look at its price action, I plotted what the average 55.5% would look like if EMCOR achieved it this time around, bringing an upward target of around 1175 on December 31st of this year. I also plotted out a secondary, more conservative target at its all-time highs at about 26%, as EMCOR has had quite the bull run the last 3 years, and it's likely a bit more mature in its business cycle, meaning less intense growth opportunity for the future. So not to say that it can no longer achieve a 55% jump again, just note that as its market cap grows exponentially larger, it becomes that much more difficult to achieve that same return, as you need much more capital to flow into the stock to drive its price higher. As for the downside risk, I put a stop loss of about 9.5% at about a 1 to 15 risk reward ratio, just below our support zone from the base we built back in March of this year. Looking at the historical reactions, we saw a majority of them struggle to get past about that 10% drawdown from the trigger price. And based off the worst reaction we saw, should it start trading further below that, there's likely better opportunity for the time being, and we can forget about the stock for the next couple of weeks until we start seeing signs of a potential recovery in the 4 to 6 month mark like historically. The first major thing I want to note is that EMCOR just hit its downside target from a head and shoulders pattern that confirmed on May 29th of this year. If you have watched my videos before, you've likely heard me talk about this pattern, but what it calls for is a head and 2 shoulders to play out along a neckline, in which when the price breaks below this neckline, it calls for a downside move equivalent to the peak of the head to the base of the neckline. So as you can see, I drew a perpendicular trend line from the head to neckline and copied it over to the candle in which it closed below the neckline, bringing the downside target to $726.68. Now we have bounced off this target as well as our 200-day MA pretty vigorously, showing some potentially large buyers are showing interest at these lower prices. If we continue to hold the 200-day MA, it's likely we see a retest of $777 to $795 a share, along with the neckline of the head and shoulders pattern we broke initially at 830.75, should we continue to trade through our first target. It also just hit its downside target on the ABCD pattern it confirmed on July 7th, in which with ABCD patterns, it's a zigzag move, in which on the B to C move, you typically retrace about 61.8 to 78 of your A to B move. From there, if you come back down and break past the low realized in your B to C move, it calls for a target between the 123.6% and 161.8% retracements of your B to C move. As you can see, on July 7th, we breached into this zone and we are now attempting to bounce out. These D target zones are often met with very strong support on the downside moves and resistance on upside moves, marking the last pivot in the trend before it shifts to the counter trend. So in other words, these zones are often when you switch from a downtrend to an uptrend and vice versa. If we continue to trade back out of that green zone, and especially if we start closing back above 774 at our B point, it's fairly likely we go on to continue further to higher resistance levels around 830 to 880. Now, to add more evidence to why I believe we could be seeing the ends of this downturn, is that ABCD move we just talked about could be a part of a bigger ABCD pattern, in which that zigzag that occurred fell within the time frame of our B to C move with this larger ABCD pattern we are viewing here. So in technical analysis, these patterns can be fractal, meaning the same pattern could occur at a smaller scale within the same type of pattern on a larger scale like you're seeing here. So like I said before, when prices reach 61.8 to 78.6 retracements of the A to B move, it is often the last pivot that marks a shift in the counter trend. So if we start closing back above our 61.8 retracement at 787.29, it implies we are likely to go on to retest the yellow zone, which is the 61.8 to 78.6 retracements of our B2C move. Now, if we do trade up past that yellow zone and start closing past our B point, this confirms our D targets at 123.6 and 161.8 retracements of our B2C move, implying upward targets of $1,000 to about $1,100 a share. So based off our evidence of our historical reactions, as well as the price action structure that looks to be playing out at the moment, it makes me personally fairly optimistic about seeing similar returns like in history. The second stock I want to talk about today is NVIDIA, in which a buy signal from a measurement called rate of change fired off yesterday. To elaborate further, in the top panel is NVIDIA's price over the past 10 years, and in the second panel is its 3-month rate of change, which is just a rolling 3-month percent change. So on each day, it's measuring how does the current price compare to the price 3 months ago in terms of a percentage move. Now, traditionally, investors will use crosses above 0 as a buy signal with rate of change. However, something you can do is also optimize a level lower or higher than 0 that better indicates the start of a bull run. And in this case for NVIDIA, that best value is -1.5 based on our back test over the past 10 years, in which NVIDIA climbed 47.2% on average over the next 119 trading days, or just about 6 months. Over the past 10 years, we've seen 22 triggers in which just about 82% of the time the price was higher when looking out that 119 trading days. In addition to the average return of 47 it was able to achieve, it outperformed the infotech sector about 33.5% on average, and the S&P just about 38% on average over that following same period, showing some fairly strong outperformance based off of historical reactions. It's performing currently at a profit factor of 3, meaning its wins on average are about 3 times larger than its losses on average. So when you win, meaning the price ended up above 0%, you won about 62% on average, and when it was a loser, in which it was in the negative by that 119th day, the average loss was about 20%. So you're seeing about a 3-to-1 upside potential versus your downside risk. Taking a look at NVIDIA's reactions to those ROC buy signals, in blue we can see the average percent lead up to just about that 47.2% on the 119th trading day out from our buy signal. Also notice we do have some historical triggers that are still active stemming back from January of this year, with all of them actually being up as well despite the little dip NVIDIA has experienced over the past 3 months. Now looking at NVIDIA's price action, if it were to achieve that 47.2% on average, it would put it at just about $312.26 a share on January 11th of next year. As for downside risk, I put a stop loss about 10%, just lower than this major support zone that has been developing since February of this year. Now, a few things I want to note here. NVIDIA is currently trading within a triangle. As I said many times before, whichever direction it breaks out of the triangle usually indicates it will continue to go in that direction and go on to test the pivot lows or highs that were created along the way in the direction of the break. NVIDIA is also currently testing a major resistance zone in which it marked major inner structure pivots. So paying attention to how it responds to this zone can give us a good idea of if it's ready to go further up or reverse to retest the bottom of our triangle, as well as the support zone down at about $191 to $200 a share. Also notice this major resistance zone is currently the neckline of an inverse head and shoulders pattern, which is the traditional head and shoulders pattern but just upside down, indicating bullish momentum instead of bearish. So not only if we break this resistance zone is it a strong bullish break, but it also confirms our inverse head and shoulders pattern, which calls for a move in the direction of the break that is equivalent to the distance of the trough of the head to the base of the neckline in this case. In traditional head and shoulders, it would be the distance of the peak of the head to the base of the neckline. So as you can see, I copied this purple dashed trend line and pasted it at the neckline. So if we were to close above our neckline tomorrow, this could indicate we do go on to retest NVIDIA's all-time highs, especially so if we break through the top of our triangle as well. That is everything for today. If you enjoyed the video, please give it a like and subscribe, and I hope to see you in the next one.